Our first problem that we're going to do is just a basic, simple investment. Let's say you're investing $1 for 5 years, getting a 10% rate of return. 10% is the average rate of the stock market. So we're going to take $1, multiply it by 0.1, a 10% return. That gets us 10 cents. We add back our original dollar, and we get $1.10. We invest $1.10 the second year times 0.1 gives us 11 cents, plus our original $1.10 gets us $1.21. Now, here's one of the interesting things. This penny right here doesn't seem like it's necessarily a lot of money. But instead of after 2 years at 10%, instead of having $1.20 here, we got $1 and a penny. And that penny is what Einstein called the magic penny. This penny represents compounded interest. This is what's going to make somebody in your life a millionaire. You're going to probably make $3 to $5 million in your lifetime. Someone's going to end up a millionaire. It's going to either be you, GMAC for all the cars they sold you, Visa, American Express, or whoever. Okay? But someone is going to take your work, invest it, and make millions of dollars. And we want it to be you. So then I'm going to take this $1.21 times 0.1 equals 12 cents plus our $1.21 back equals $1.33. Now instead of having just one extra penny, we have 3. And believe it or not, it really starts to take off much faster than you could imagine. Now I'm going to take $1.33 times 0.1 equals 13 cents plus my $1.33 equals $1.46. $1.46, the last one we're going to do, gives me 14.6 cents plus my original $1.46 back equals $1.61. So, whereas we started out here after 2 years of investing, we just had an extra penny, then we had an extra 3, then we've got an extra 6. Now, after 5 years, we actually have more than 1 whole year's interest. And we're going to start using what we called our time value of money charts. If you go into your book, under supplemental materials, you'll see there's a lot of supplemental materials. Within that book, there's your time value of money sheets. There's 4 time value of money sheets corresponding to, earlier we talked about the 4 different things that we're trying to do in moving money around. And so this one is called the future value of $1. We're moving $1 out in the future 1 year, 2 years, 3 years, 4 years, and 5 years. If you look at your time value of money sheets, you'll see table A1 is present value of $1. The next one, present value of an annuity. And then chart 3 is future value of $1. And so if you slide across the top of the chart that has the percentages, we go to 10%. If you slide down the number of periods, which for our class in here is each period is going to be a year, doesn't have to be. There's a lot of playing around with that we can do. But for this class, 1 year equals 1 period. So if we drop down 1 period, you'll see there it's 1.10. The second period, 2 years, 1.21. The third period, 1.33. Fourth, 1.46. And then $1.61 at the 5th year. So what these charts are doing for us here, it enables us to skip all of this work that we had to do on the board and sums it up for us right here. So now we can go forward without having to do so much math. But I just want to do this so you can see how those charts are built. All right, so let's get into a problem that might be reflective of something you might be curious about. Okay. A lot of students look and they say, well, I don't know why I would be investing. It doesn't matter. Small amounts of money don't add up to a heck of a lot. So therefore, I'm just going to go out and spend my money and enjoy my life. Well, certainly it's important that you spend some of your money and enjoy your life. We know that's true. We do not want to end up at 65 or 70 having never spent any of our money, having $8 million in the bank account, never watching your kids play baseball, never going on vacation, never doing anything like that. That is an abject failure of a life. The same as we don't want to spend every single dollar we have and then end up at 65, 67, 70, dead broke, having to live in a care facility, being in horrible conditions or homeless or whatever is going on. So there's got to be some happy medium in there. And so what we want to do is we want to give you guys tools to make good decisions. So some of the things we look at is how many people smoke. On campuses, probably about 30% of people smoke, which is fine. You know, if you're smoking, that's your decision. In fact, we need more people smoking, quite frankly, because the more people that smoke, the more cigarette taxes get paid, which means more income for school, which means my salary goes up, so I'm all for that. Plus, you're going to end up dying of something, so you might as well die of lung cancer at like 68, and then we don't have to pay you much Social Security, we don't have to pay you much of that. So really, the most American thing you could do right now is to smoke as much as you can, pay a boatload of taxes, die and get out of the way, okay? But, you know, everybody looks at it and says, well, that's so horrible. Well, no, that's your choice. You've decided to. Just like I probably eat out a little too much, and I really enjoy Chipotle. Other people stop at Starbucks every single day and buy a $4.75 mocha latte, whatever it is. I don't even understand when they're ordering these things what they mean. And in fact, when my daughter wants one, instead of me telling the barista what they want, she just texts me so I can just take my phone and go, here, whatever this thing says. I don't know what it says. Okay, so, but I think most of us could probably agree that there's $5 a day we could cut out of our life. So if we cut $5 a day out of our life, how much money would you have when you retire so that we can make a good decision? So if we went $5 a day times 365, that means that we're spending about $1,825, right? Doesn't necessarily seem like an awful lot of money. Now what we want to do is say, well, if I'm retiring, say 50 years from now, how much money will I have? Well, when we did those different charts, we had future value of $1. We calculated that one. This one's called future value of an annuity because we're going to be spending our $1,825 every single year. Right? People who are smoking aren't going to stop smoking. People going to Starbucks probably aren't going to stop going to Starbucks. And so let's see how much money we'd have. If we take 1825 times what we call the future value of an annuity, and our interest rate was 10%. K stands for interest rate. We'll get back to how that is in a little bit and why we use the symbol K. N equals 50. So what I want to do is I want to go to the chart that's labeled A4, future value of an annuity for each dollar. We're going to slide across the top, and if you slide across the top, you see 10%. Then we're going to slide down the chart until we hit 50 years, which is the second one from the bottom. And that factor that we have is 1163.9. So what we're going to do is take our $1,825 times our factor of 1,163.9, multiply those, and that's going to tell you how much money you're going to have at retirement. And when we multiply those out, that equals $2,124,117. An awful lot of people now are probably saying, well, you know what, I think I'll quit smoking. I'd rather have $2 million. Or I think, you know, maybe I should eat out less. Maybe I should give up Starbucks. That's your decision. It really doesn't matter to me what you guys do. What matters to me is that you're able to do this calculation, you understand how this calculation works, and so now you're going to make an informed decision. This is how much money I have if I quit smoking or I stop going to Starbucks. Maybe you're smoking and going to Starbucks. You know, I don't know. But now you can make an informed decision. For me, I'm probably not going to stop going to Chipotle. I like Chipotle. I eat way too much there. There's a lot of other things that, you know, I could cut somewhere else, but I'm going to keep going. All right. Keeping going, we're going to do a couple more problems here. Remember, there's 4 things we're doing with money because we got 4 charts. Your charts in your book start under supplemental material, page 19. If you remember, up there we got the future value of $1, the future value of an annuity, the present value of $1, and the present value of an annuity. Those are the 4 charts that we have. When we're doing these time value of money problems, it sounds kind of silly, but it works out well if you start drawing this little box. Okay, we got K, we got N. Present value, kind of under this axis. Future value on this side. Now, we're going to talk about K here a little bit. And a lot of people probably are wondering, well, how come we don't use I for interest rate or something like that? In finance, I tends to sometimes stand for the inflation rate. Sometimes it stands for the pure rate of return you want after all risk adjustments are made. K adds all the risks associated with an investment together to get the ultimate number that we're going to discount. So if you want a 3% rate of return after everything's done, you start off with, I want a pure rate of 3%. We might then have inflation, and you think inflation's going to run 2%, right? You got to at least keep track of inflation. Plus, you think that this investment has a 5% chance to default. So we add 5 to that. We can come up with 30, 40 different risks that are incorporated into K, but these are the 3 of the largest. So I'd add up that, and that equals 10. And so I have to get at least a 10% rate of return to equate for how much money I want afterwards as far as my pure rate of return. After all said and done, inflation, default, we can add specific risks for companies' failures. We can add indirect risks such as 9/11, technology changes, the risk of the owners getting sick and dying, et cetera, et cetera. There's just a multitude we can come up with. And N here is number of periods. So let's do a problem. And we're going to do a problem where if I invest $500 today for 5 years at 10%, how much money will I have in 5 years? And so I'm investing $500 today, so I'm going to put $500 here under present value. And I said I'm investing $500 today, and I want to see how much I have in 5 years. I did not say I'm investing $500 each year or $500 every year. If I'm investing $500 every single year, that is an annuity, right? But this one is not an annuity. So I want to know how much I have in 5 years. So I'm taking my $500. I am going out into the future. It's not an annuity. It's a lump sum. So I'm going to use the future value of $1 chart. And if we look up the future value of a dollar chart, which we calculated earlier, and I look up K equals 10, N equals 5, there you're going to find a factor of 1.6105. We're then going to take $500 times 1.6105 and see how much money we're going to have 5 years from now. And that comes out to $805.25. So here's like one of the questions. What would you rather have, $500 today or $805.25 5 years from now if exposed to a 10% risk? It's not necessarily the easiest decision to make, right? When I ask this question in class, about half the people would rather have $805.25. About half the people would rather have the $500 today. And there's about 2 or 3 people in class that are asleep. Where actually the people who are asleep and don't care is actually the right answer to this question. Because financially, $500 today or $805.25 exposed to a 10% risk for 5 years, this financially is the same number. So if I told you you've got this investment you can get in for only $500 at a 10% risk, and it's going to pay you $900, we would go ahead and say, all right, I'll take the investment because it's worth more. Or if I came to you and said, hey, I got this great investment, it's got a 10% risk, you invest for 5 years, you're going to get a 50% return on your money. You're going, wow, that sounds pretty good. So we're going to take $500 investment, and we're going to turn it into $750 5 years from now. So do you want to do that deal? Hopefully the answer to that's no, right? Because it's not worth the $805.25. And so we would reject this because financially we'd be losing money. If the investment was going to pay us $805.25, my response would be, maybe. You know, maybe I'll invest, maybe I won't. Do I think I've got some better investments coming up? I might just wait around and sit on my money. If I don't think I have any better investments coming up shortly, I might go ahead and invest. If I was going to get a rate of return of $900, then definitely I'm taking in that investment. That is a good deal. So then the question comes about, is this really the same number? Okay? Well, if it's the same number, then what I should do is I should be able to do what's called discounting. I'm going to take this dollar amount, move it back in time, and I should end up back at $500. So what chart do you think we would use? We're obviously not moving several payments of $805 back in time, so it's not an annuity, and we're coming back to the present, so we would be using present value of $1. And so what I want you to do now is pause this and go ahead and do that calculation. When you're done with that calculation, unpause it, and I'll have it worked out here for you. So we're going to look up present value of $1 on our chart. And if we look up present value of $1, we can see there that the factor is 0.62. All right? If we calculate $805.25 times 0.62, what we're going to end up with, within rounding, we're at $499.98. If we would have carried this out several additional decimals, both on the top side and the bottom side, we would have came back to $500. And so within rounding, this is $500. So if I take $500, move it out into the future at an interest rate and a certain number of years, and then turn around and discount it back in time at the same rate for the same number of years, I'm going to end up back where I'm started, right? And that's how those two interrelate. Okay, let's move on to a couple more problems that we have here. So whenever we're doing any financial time value money problems, especially at the beginning, we're going to start off making this box. This really helps, especially if you guys get lost. Okay, I'm going to go ahead and pre-fill this out right here. Now when I read my question, I can go ahead and start plugging things in, even if I'm not 100% sure. So we're going to start off here and say, you're a machinery salesperson. And one thing that salespeople have to be able to do is talk money. If you're in any position and you're talking to management, you want to be able to talk about what's profitable, what's not. You want to put it in their nomenclature, and the odds of you getting promoted is much, much better. So let's say you're selling machinery, and sitting here right now is a $50,000 piece of machinery right in front of me that you're trying to sell. So a $50,000 piece of machinery sitting right in front of me today is worth $50,000. If you go to sell this to some small business, do they have $50,000 sitting in their checking account? Odds are no, right? What they're going to do is borrow the money and put this piece of equipment into service. It's going to either increase their profits or cut their costs, and they're going to use the savings or additional profits to pay for that piece of machinery. So let's say that you get promised $20,000 each year for 3 years, a total of $60,000 over a 3-year period. Do you want to trade 3 payments of $20,000 each for a $50,000 piece of machinery? All right, some people say yes. That sounds like a great deal. We're getting a total of $60,000, and we traded for a $50,000 piece of machinery. Some people will look at this and say, well, no, because this $60,000 spread out over time, our first basic tenet of finance, dollars out in the future are worth less than dollars today. So somehow this has to be worth less than $60,000. If you think $20,000 spread out over 3 years is worth $60,000, then I need you guys to email me right away. And this is what we'll do. You give me $60,000, and then each year I will pay you $20,000 for 3 years. Sounds like a great deal for me. I need to pay off my house and do a whole bunch of stuff. Because what I'll do is I'll just take that $60,000, drop it into the bank, I'll make interest on it, and then each year I'm going to pay you this $20,000, and at the end of the 3 years I've got the interest free and clear, not even counting if I invested that money. So some people pick the 20, some people pick the 50,000, but the real answer is we've got math stuff we have to do, right? We've got to figure out these values. So what I'm going to do is discount back these 3 cash flows. All right? The first time we're going to do this, we're going to calculate it the long way. Although this is annuity, what I want you to do is calculate this as present value of $1. All right? We're going to use 10%, and this is a total of 3 years. So in the problem here, this is n equals 1. This is n equals 2. And that one's n equals 3. I want you to use present value of $1, discount these 3 back, add up the 3 cash flows, and tell me whether or not it's worth $50,000. And go ahead and hit pause and do that, and then unpause it when you think you have the answer. All right, if we looked up on our present value of $1 chart, we saw at k equals 10, n equals 1, that our factor here was 0.9091. The second year was 0.8264. Our third year was 0.7513. we're going to then multiply $20,000 times 0.9091 times 0.8264 times 0.7513. And the values we end up with is 18,182, 16,528, and 15,026 for a total value of $49,736. So a couple things we're going to make note of here. Each dollar a year from now is worth about 91 cents. Each dollar 2 years from now is worth about 82.5 cents. And each dollar 3 years from now is really only worth about 75 cents per dollar. Okay? So we're going to go ahead, we multiply across, we add it up, and we end up short. So the financial value of these $20,000 spread out over 3 years is $49,736. So then the decision comes, do we sell them the piece of machinery? The answer is no. Obviously, we want to make this work, and so there's two basic ways that we can make this work. We either increase the amount of money that they're going to give us, or to make this more valuable, we have to shift money from, say, year 3 forward to year 2 or year 1. If we take $1,000 and shift $1,000 from year 3 to year 1, then instead of having each dollar worth 75 cents, those dollars are worth 90 cents, and we will increase the total value of our cash. If we went the opposite way and we took money in year 1 and pushed it back to year 3, then we're going to make these set of cash flows less valuable. All right? So one of the easiest things we could do in this negotiation is just say, hey, I'll tell you what, why don't you give me a $500 down payment? $500 down payment, $500 today is worth $500. And so we're going to add that to our $49,736. Instead of having a financial loss here about $250, we have a financial gain of about $250, and that's going to work out really well for us. Okay? If we consistently traded a $50,000 piece of machinery for these cash flows over time that's worth less than $50,000, we will end up losing money and eventually go out of business. Some deals might work out great, and we get the full $60,000. But some of these are going to default, and we might only get $20,000, or we might only get $40,000. And so this is a must-do to any financial deal. Now what I want you to do here is to take these three numbers and add them up. Okay? Add up 0.9091 plus 0.8264 plus 0.7513. If you add those three numbers up, what you will find is that they add up to 2.4868. So what we can do now is go to our chart, which is the present value of an annuity chart. And if you look up on the present value of an annuity chart, under K equals 10, N equals 3, you will find 2.4868. Actually, on the chart, because of rounding, that's a 9, but it's just a rounding error. No big deal. So when you look at these two charts, the present value of an annuity chart is basically the summing up or the adding together of the present value of a dollar chart. So in case these cash flows, in case there were 50 of them, we don't have to go through all this work 50 times. We just look up present value of an annuity, K equals 10, N equals 50, and it gives us all the discounted values on the way back. Here's one mistake that probably 8% of my class makes every single time. To come up with the answer of what these cash flows are worth, we're going to take $20,000 times the present value of an annuity. And so it's 20,000 times 2.4868 equals our number right here, 49,736. Now, about 8 people or so are going to make the mistake where they look at this and go, oh, okay, well, times present value of an annuity, I get the factor, multiply it. There's 3 cash flows here, so now I have to multiply this by 3, and they'll end up with a dollar amount somewhere just short of $150,000, which on its face, it just can't work. How could $20,000 spread out over 3 years be worth $150,000? It can't. Once again, I would really like you to email me if you think that's true, because I'll take your $150,000 every single day and then pay you $20,000 each year for 3 years. So obviously, that's going to be a mistake. You don't need to multiply by 3 here, because this number up here on the present value of an annuity chart has already contemplated, it has already added these 3 up to get that number. And then that's how we got that number. Okay, so we're going to do another problem. We did present value of $1. We brought everything back individually. We did present value of an annuity. And now we're going to do future value of $1 and future value of an annuity. So let's just take what's basically the exact same question we just did, and we're going to reverse it. So instead of being promised $20,000 each year, what we're going to do is we're going to invest $20,000 each year for 3 years at 10%. So instead of coming back in time, like we did before, present value, we're going out into the future to see what it's worth out in the future. So we're going to take the $20,000, move it forward, move the second cash flow forward, and move that third cash flow forward, and figure out how much money that we're going to have. Now, something interesting on the future value of an annuity chart, kind of quirky. The very last payment that is made, what happens is you deposit it into the account and it's immediately valued. So what happens is, under all scenarios, this last cash flow is 1.0 because it doesn't spend any time in the account earning interest or anything. You deposit and value. When you get into the second year, this money's actually been in the account for only 1 year. This money's been in the account only 2 years. And so there's a little bit of a quirk there. Don't worry, you're not going to see it on any of your exams. All right? So 10% rate of return here is actually 1.1. And if you remember from us calculating the magic penny one before, 2 years is 1.21. So now what I want you to do is kind of the same thing that we did before. All right? Go ahead and hit pause. Multiply these 3 out, and then add up how much money we're going to have. Okay, so hopefully none of you had to use your calculator to multiply 20,000 times 1.0, although I'm sure a lot of you did, just because it's habit. So that's obviously $20,000. $20,000 times 1.1. Hopefully you don't need your calculator for that one either. Right, because 10% of 20,000 is 2,000 plus 20,000. That's 22,000. And the last one, 20,000 times 1.21, gets us 24,200. We add those together, and whoops, we add those together, right? We got 200, 6, 6. We end up with $66,200. If we do the exact same thing that we did last time, which was to add up these three factors here. What we used here was future value of $1. We moved all these forward individually, which is something we would have to do if these were dissimilar cash flows. If this one was 20,000, this was 25, and this one was 30, we would have to bring them forward individually. We could not use future value of an annuity. But if we add up these three numbers, 1.0 plus 1.1 plus 1.21, we end up with a number that is 3.31. If you slide over to your future value of an annuity chart, and you slide across the top, and you get to 10%, and you come down 1 year, you'll see 1.0. And you'll see 1.0 under 1%, 1.0 under 5%, 1.0 under 15%, because it doesn't matter. It immediately values it. If you slide down future value of an annuity chart, 10%, 3 years, you'll see 3.31. So instead of having to go this the long way, we could have took $20,000 times 3.31, and we would have gotten the same 66,200 when we multiplied those two numbers together. Okay, let's do another problem. Let's say that I'm going out and I want to buy a new car. A lot of people want to buy new cars. One of the things that's frequently offered in new cars is 0% financing or discounted financing on new cars. And there's two caveats that you're given. One is that typically it's in lieu of cash back. So you can either pick cash back or you can pick 0% financing. Plus, it has to be what's called on approved credit, right? Okay, so we're going to start out, we draw our box up here, and here's our decision. I want to buy a $25,000 car. And the car comes with $4,000 cash back. And so the cash price today of that car is $21,000. Because if I buy it cash, they give me a $4,000 check. As it sits right here, it's worth $21,000 bucks. Or I can take 0% financing, which means I am going to pay $5,000 each year for 5 years to pay a total of $25,000. K, in this instance, is the risk of the buyer. So these typically are on approved credit, which means you have to have B plus credit. Most of the times, right in the advertising, it'll say you have to have 740 credit or 720 credit. If they're really trying to get rid of the cars, they'll lower it down to B minus credit, and you'll see 680. If it's Audi, Mercedes, or some of the really expensive automobiles with longer-term leases, you'll see right in there it says they want 790 credit, or sometimes it'll say 810 credit. Anything getting above 800 is very hard to qualify, and a lot of people just don't. So we're going to use what would be a B credit person right now, which is a risk of about 6%. That's what they'd be charged if they went out and got an auto loan just from any regional bank. This is spread out over 5 years. And so the question is $25,000 spread out over 5 years worth more or less than $21,000? And our decision that we're trying to make here is actually to buy the car as cheap as possible. So we want to discount all of these cash flows back. We could do that individually using present value of $1, but we already did that, and I'm going to be a little bit more lazy this time around. Since these are even cash flows, what can we use? We can use present value of an annuity. So I'm going to look up on my chart, present value of an annuity chart, K equals 6, slide down to 5, and see what that factor is. And that factor is 4.2124. So I'm going to multiply 5,000 times 4.2124 to get what's the value of these cash flows. And when I add that up, it's worth $21,062. So if you're purchasing this car, do you want to pay $21,000 for the car? Or do you want to give the dealership a set of cash flows that's worth $21,062? Well, I think it should be obvious. You want to buy it the cheapest way you can, so you're going to use $21,000 and pay cash for the car and take the rebate. That's also one reason why you want to save for a car, so you can take advantage of rebates and everything like that, and you don't want to pay all the interest to the car. You'd rather keep all that interest for yourself. So the one caveat that we talked about there on approved credit, why is that so critical? It's actually a really critical issue that comes up quite a bit. Because if, instead of having B plus credit here, right, at 6%, what if this was D credit, which is about 12%? And so I know it kind of works opposite here, but what we're doing is we're moving back in time, so we're discounting. If we discount heavier, the bigger the discount, the lower this number is going to be. Think of it if you walk into a store and you want to buy a leather jacket. Would you rather walk into the store and the jackets were 6% off? Or would you rather walk into the store and have jackets 12% off? You'd rather have them 12% off, because when you're discounting, this is going to be smaller. So let's go to the chart and see what that number is. So we're going to go to present value of an annuity chart. K equals 12, N equals 5. We look up that number, and that factor is 3.6048. We multiply those across, and we get a value of $18,024. So now the question comes, would you rather give the dealer $21,000 cash or a set of cash flows that's worth $18,000 or $18,024? The decision for you, the buyer, is easy, right? You're going to give them the cash flows that are worth $18,024. What's the dealer going to say? No thanks. It's too risky, because safer money is worth more. And so the safer money in these cash flows was worth $21,062. The dealer doesn't have any problem basically trading a $21,000 car for a set of cash flows worth $21,062. They say on approved credit because they don't want really risky cash flows up here, risky payments. Likelihood of default is very high, which makes the value of this lower, because risky money is worth less than safer money. So now it's worth only $1824, and they're going to say no dice to that one. Okay, we're down to kind of our last concept here for the introduction to time value of money. One of the problems in moving money through time is kind of conceptually getting that as interest rates go higher when you're discounting, that the value goes lower. When we just did the car example, a lot of people say, well, wait a minute, the interest rate went from 6% to 12%, so the value of that car should go up, not down. So how does that work? Well, what I want you to kind of think about here is kind of like a teeter-totter. You got $1,000 today, and we're looking to go to present value, moving back in time, or out here to future value and going forward in time. If the interest rate is 0, then the slope of my line here, or the slope of this teeter-totter, is 0. So $1,000 moving back when there's absolutely no discount is $1,000. $1,000 going out into the future when we're getting zero investment return is $1,000. But as soon as you introduce an interest rate, or basically what is a slope to that line, we start getting differences. So if I put a 5% slope to this line, now I got a 5% line. Each year we move out into the future, the value goes up by 5%. Each time we go back in time, our value drops by 5%. So we know on this side of the line, when our interest rate increases, we get more money. We get a better rate of return, which is true. If I put a 10% slope on this line, then obviously the slope over here is much steeper, so at any point when I look at investments, 5 years from now, 10 years from now, my 10% rate of return, I will have made more money than in a 5% investment. The same is true over here. Because it's the steeper slope, I am discounting 10% every single year, and so I am losing more and more and more money because my discount gets heavier. And so if we look at something, say, incredibly extreme, and I'm going to maybe do something to say 30% or something like that, we'll have huge increases as we go up. And so if we're going back, if we're going out into the future, we're going to make a whole ton of money at a 30% slope. I wish I could get 30% every year. The same is true if we're going back in time and we're doing a 30% discount. We are going to have huge losses, and we're going to approach zero actually pretty quick if we lose 30%, then 30, then 30, then 30, then 30. So I hope that kind of helps you visualize the slope of the lines, that as we go out in the future investing, a bigger interest rate gets us more money. If we're going back in time to the present, a bigger interest rate means bigger discounts. And if we look at bigger discounts, that's just like we're walking into the store and we want to buy that leather jacket. What's going to be cheaper? The leather jacket that's 5% off or the leather jacket that's 30% off? The money amount's going to be lower on the jacket that's 30% off. Okay, what I'd like you to do now, hopefully, or maybe you've already done, is go to your book, and starting on page 6 in your book, it says future value of $1. Explains how to do that. And by the way, this is under supplemental material, where if you bought your book, you've got supplemental material, you've got the PowerPoints, and then you got the regular textbook. Under supplemental material, page 6, future value of $1 gives you 10 questions. So go ahead and do those 10 questions. Then on page 8, you have future value of an annuity, describes how to do that, and then 10 questions. And then you've also got present value of $1 and 10 questions, and present value of an annuity and do 10 questions. Very important that you do these 40 questions. It is going to aid you a lot in getting on the right chart, sliding down, picking up the right number. So make sure that you do those, whether you're in my distance ed class or you're in my traditional classes.